Now the next ratio is our activity ratio, which is also known as turnover ratio, also known as performance ratio. Is it clear? So activity ratio, third ratio is activity ratio. First one we have discussed liquidity ratio, second one solvency ratio, third one activity ratio. Third is activity ratio, which is also known as turnover ratio, also known as performance ratio. Under this ratio, we will calculate these ratio: inventory turnover ratio, average age of inventory, trade receivable turnover ratio, average collection period, trade payables turnover ratio, average payment periods, and working capital turnover ratio. So one by one we will see all these ratio under the activity ratio. We will see one by one. So what is activity ratio or turnover ratio? Through this ratio, the company want to see or interested to know how effectively the resources at the disposal of the company are being utilized by the company, how the resources are utilized by the company, okay, whether it is utilized effectively or it is not utilized effectively. For that we find out or calculate the activity ratio. We do the comparison. We find out the inventory turnover ratio, average age of inventory, okay, trade receivable turnover. Receivable means both bills receivable and debtors, average collection period, trade payables turnover ratio, average payment period, and working capital turnover ratio. So first one we will see inventory turnover ratio. This is the first one. We will see inventory turnover ratio. Now our first ratio is inventory turnover ratio. Inventory turnover ratio is equal to cost of revenue from operation upon average inventory. So cost of revenue from operation upon average inventory. The resultant will be in times. It may be 2.5 times, 3 times, 4 times, like that. We will express this in times. Now second is how to calculate the cost of revenue from operation. Cost of revenue from operation is equal to opening inventory plus net purchase plus all direct expenses minus closing inventory. Okay, that depend upon the information given in the question. Another way to calculate the cost of revenue from operation is revenue from operation minus gross profit. If the gross profit is given and revenue from operation is given, then revenue from operation minus gross profit indicate your cost of revenue from operation. Similarly, instead of gross profit, gross loss is given, then revenue from operation minus plus gross loss indicate your cost of revenue from operation. Now we will see, you see the cost of revenue from operation: opening inventory plus purchase plus direct expense minus closing inventory. Another is way revenue from operation minus gross profit is cost of revenue from operation. Revenue from operation plus gross loss indicate the cost of revenue from operation. So it totally depend upon the information given in the question, how the information has given. Average inventory, opening inventory, inventory at the first day of the financial year, plus inventory at the last day of the financial year. We will add it and divide it by 2 to know the average inventory. Now see one question based on inventory turnover ratio. So the question is, now come to one problem related to inventory turnover ratio. The question is, calculate inventory turnover ratio and average age of inventory from the following. One statement of profit and loss is given. Under this statement, revenue from operation is given, expenses is given, purchase of stock in trade, change in inventories of stock in trade, employee benefits expense, note number 2, other expenses, in note number 3, total expense and profit before tax. In note number, change in inventories, opening inventory and closing inventory is given. Note number 2, employee benefit expense, wages and salary is given. And note number 3, other expenses, carries inward, carries outward and miscellaneous expenses is given. So to calculate the inventory turnover ratio, we know the formula of inventory turnover ratio is cost of revenue from operation upon average inventory. First of all, you write this one. So inventory turnover ratio, you write this one, inventory turnover ratio is equal to cost of revenue from operation divided by average inventory. First of all, we will write the formula. Cost of revenue from operation upon average inventory. Here in this question, average inventory can easily be calculated. Average inventory in the note number 2, note number 1, opening inventory has given opening inventory, closing inventory upon 2. So opening inventory is 60,000, see the note number 1, plus closing is 68,000 upon 2. So it's a 1,28,000 upon 2. It means it is 64,000 is the average inventory. Thereafter we will find out the cost of revenue from operation from the given information. Cost of revenue from operation. Okay, here for cost of revenue from operation, you see purchase of stock is given in the expense. First you will write the purchase of stock plus change in inventory. Change in inventory means opening stock minus closing stock. If opening stock is more and closing stock is less, then plus, and if closing is more than opening, then the figure will be reflected in minus. Okay, so here the figure is reflected in minus. Next is employee benefit expenses. Under the employee benefit expenses, wages and salary is there, wages and salary. So we'll take the wages only over here. Salary is indirect expense, wages is direct expense. So only wages will be taken into account because wages is direct expense. Plus carries inward, see the note number 3, carries inward, okay, carries inwards. So purchase of stock in trade is 2,50,000 and change in inventory is given in minus, it is minus. So minus how much? Minus 8,000. It is the minus. Change in inventory figure is in minus. Plus wages is 58,000. Will take the wages. Salary I am not going to take because salary is indirect expense. Plus carries inward, which is a direct expense. Carries inward is 20,000 is the carries inward. You add it. Okay. So 2,50,000 minus 8 plus 58 plus 20. So it is 3,20,000. 3,20,000 is the cost of revenue from operation. Okay. So you write the formula over here. You write it. Cost of revenue from operation is equal to what it is? Revenue from operation is 3,20,000 and average inventory is how much? 64 is the average inventory. So it is how much? 5 times. It is 5 times. Comes as a 5 times. Okay. Is it clear? It's a 5 times. Now next we will calculate. Here that the question is average age of inventory, average age of inventory is equal to number of days in a financial year. It is 365 days upon inventory turnover ratio 5 times. Inventory turnover ratio is 5 times. So number of days in a year, we'll take it. It may be 365 or 366 depending upon, or if you calculate in months then you take 12 months. 12 upon inventory turnover ratio 5 times. Okay. So 365 upon 5. So it is 73 days. 73 days. It is what? It is days. 365 is the days. So answer is in days. So average age of inventory is 73 days. It means in our stock, in our godown, the inventory laying for 73 days. It takes time to convert into sale for 73 days. So we need the working capital for 73 days. Okay. As much as it is less, that much beneficial for the company. If inventory turnover, average age of inventory will be less, that much it is beneficial, and as much as it is high, that much the company is not in a position to convert the inventory into sale. It indicates that the company is not able to convert the stock, convert the inventory into sale. If it is high, days are high, so days should be less. If the days is less, it means company is in a position to convert the inventory into sale quickly. So these days should be as less as possible. Okay. Now see the another question related to inventory turnover ratio. Question is calculate inventory turnover ratio from the following information. When gross profit ratio is 25%, gross profit ratio is 25%. You know the formula of gross profit ratio. Gross profit ratio is equal to gross profit upon sales. Sales means revenue from operation into 100. Gross profit formula is, you know the gross profit ratio is equal to gross profit upon revenue from operation into 100 is the gross profit ratio. So here the gross profit ratio in this question is 25%. The informations are credit sales, cash sales, return inward. Return inward means sales return, opening inventory and closing inventory. So first of all, we'll write the formula of inventory turnover ratio, cost of revenue from operation upon average inventory. Now in this question, cost of revenue is not directly given, but here the sales revenue from operation is given. Revenue from operation is given. Revenue from operation is given in this question. So revenue from operation is equal to what? Cash sales and credit sales. Credit sales is given. Credit sales plus cash sales and minus sales return, that is return inward. Return inward is what? Return inward is sales return. So credit sales is 2,70,000, cash sales is 1,50,000 and return inward is 20,000. So it is 4,20,000 minus 20,000. So it is 4 lakh. Revenue from operation is 4 lakhs. Revenue from operation is 4 lakhs. But we want the cost of revenue from operation. So this one clue is given, 25%. GP is 25%. Okay, GP is 25%. So we'll calculate the gross profit ratio. Gross profit ratio is 25% of gross profit. Will calculate the gross profit. Gross profit is equal to revenue from operation into percentage is what? It is 25%. GP is 25% of revenue from operation. So 25% means 1 by 4. So it is 1 lakh. GP is 1 lakh. Okay. And you know the cost of revenue from operation will be cost of revenue from operation is equal to revenue from operation minus GP minus gross profit. If you deduct the gross profit from the revenue from operation, you will get the cost. So revenue from operation is 4 lakhs and GP is 1 lakh. Gross profit is 1 lakh. It means cost of revenue from operation is 3 lakhs. It is 3 lakhs. Okay, cost of revenue from operation is 3 lakhs. Now opening and closing inventory has given. Opening inventory is 55,000 plus closing inventory is 45,000 upon 2, then it's a average inventory. So 3 lakhs upon, it is what? Total is 1 lakh upon 2, 50,000. Okay, it is 50,000. So 6 times. It is 6 times. Answer is 6 times. Okay. So in this question, revenue from operations, we need the cost of revenue from operation, but in the question revenue from operation is given. Credit sales plus cash sales minus sales return is your revenue from operation, and this revenue from operation, if you deduct the gross profit, then you will get the cost of revenue. Gross profit is how much? Gross profit is 25%. 25% of what? 25% of sales. Whenever we say the gross profit ratio, GP upon revenue from operation. Revenue from operation is your net sales into 100. So indicate in terms of sales. So sales is 4 lakhs. So 25% of revenue from operation indicate your gross profit. So when you know the gross profit and you know the revenue from operation, so deduct the gross profit from the revenue from operation, you will get the cost of revenue from operation, and then we apply over here. Now see the another question to calculate the inventory turnover ratio. From the following, calculate inventory turnover ratio. In this question, opening inventory is given, closing inventory is given, revenue from operation net means net sales is given, and gross profit is given. Gross profit here it is given on 25% on cost of revenue. This is very important. Gross profit mentioned over here and information given over here on cost. So 25% on cost of revenue. First of all, you write the inventory turnover formula. Okay. So suppose the cost of revenue is cost of revenue. Suppose cost of revenue is 100 rupees. So as per this, gross profit ratio is given 25% on cost of revenue. So 25% of 100 rupees, it is 25. So cost of revenue plus, this is what? This is gross profit. This is gross profit. Okay, 25% on cost is what? Gross profit. So cost of revenue plus gross profit indicate what? Revenue from operation. Revenue from operation. Okay, revenue from operation. So when the revenue from operation is 125, then cost of revenue is how much? 100 rupees. And here revenue from operation is given. So cost of revenue is equal to 100 upon 125. When the revenue from operation is 125, cost is 100. So when it is 1, then 100 by 125, and when the revenue from operation which is given in the question, it is 6 lakhs, then cost of revenue will be 4,80,000 is the cost of revenue from operation. So cost of revenue from operation is 4,80,000. Now come to the average inventory. Opening inventory is given 28,000 plus closing inventory is 52,000 upon 2. So 4,80,000 upon this total is how much? 28 plus 52. It is 80 upon 2. So it is 40,000. Average is 40,000. Okay. So it is 12 times. 12 times. Okay. It is 12 times. So as much as it is more, if the inventory turnover is high, it's a good indications that inventory is converted into sales very quickly. inventory is converted into sales very quickly. As much as it is less, this indicates that company failed to convert the inventory into sales quickly. Okay, so as much as it is high, that much beneficial for the company. So this turnover will be very high, inventory turnover will be, and it should be very high. Okay, so this is clear. Inventory turnover ratio is 12 times. Now see the next question, best that how to calculate inventory turnover ratio. So from the following information, calculate inventory turnover ratio. Informations are purchase, carries inward, carries outward, revenue from operations, opening inventory, and gross loss. So first of all, you write the formula of inventory turnover ratio, cost of revenue from operation upon average inventory. Then see in this question how to calculate cost of revenue from operation. So revenue from operation is given, so we'll calculate the cost of revenue from operation. Cost of revenue from operation is equal to revenue from operation. This is given in the question, revenue from operation. This is given, revenue from operation is given. Okay, and gross loss is given, 10% of revenue from operation. Gross loss is, and you add the gross loss to revenue from operation, you will get the cost of revenue from operation. Here I explained it, revenue from operation plus gross loss is equal to cost of revenue. So revenue from operation in this question is 6 lakhs and gross loss is mentioned over here, 10% of revenue from operation. 10% of revenue from operation. Revenue from operation is 6 lakhs. So 10% of that is your gross loss. So it is 60,000. So it is 6,60,000 is cost of revenue from operation. 6,60,000. Okay, this one. Now come to in this question, opening inventory is given but closing inventory is not given. So we have to find out the closing inventory by putting the information of cost of revenue from operation we have already calculated, and you know that the cost of revenue from operation is equal to opening inventory at the first day of the financial year plus purchase. This information is also given in the question, plus carriage inward. Carriage inward is a direct expense. Carriage inward is your direct expense minus closing inventory. Okay, we have not taken the carriage outward. Carriage outward is indirect expense. So opening inventory is given in this question, it is 80,000. Purchase is 6,45,000. Carriage inward is 20,000. Closing inventory, we have to find the closing inventory. This is not given in the question, but you know the cost of revenue from operation is 6,60,000 is the cost of revenue from operations. Okay, so this side is, we do the total of these three. So 6,45,000 plus 20 plus 80,000. When you do the total of these three, so it is 7,45,000. 7,45,000 minus closing inventory. Okay, minus closing inventory. So what we will do, closing inventory is equal to inventory is equal to 7,45,000 minus, this will come this side, minus 6,60,000. So it is 6,60,000. Okay, 6,60,000 will deduct it. So the closing inventory is 85,000 is the closing inventory. 85,000 is closing inventory. So here opening inventory is given, that is 80,000 is the opening inventory, closing inventory is 85,000 upon 2, it's an average inventory. So 6,60,000 upon, you find out the average inventory, when you do the total of these two, so it is 1,65,000 upon 2. So it is 82,500 is the average inventory, 82,500. So divided by, you divide it, it is 8 times. It is 8 times, coming 8 times. So inventory turnover ratio is 8 times. Now the next question is, calculate inventory turnover ratio from the following informations, from the following particulars. Here the information is given: cost of revenue from operation, that is sales, cost of revenue from operation, that is cost of goods sold, gross profit ratio is given 20% on sales, opening inventory it is mentioned 4 times of, closing inventory is 4 times of opening inventory. Closing is 4 times more than the opening inventory, and opening inventory 10% of cost of revenue. So opening inventory, as per this information, if you see the opening inventory, here it is mentioned that it is 10% of cost of revenue, from operations, cost of revenue from operation, 10% of cost of revenue from operation. So 10 upon 100 into cost of revenue is given in this question. Cost of revenue in this question is 6,40,000. 6,40,000 is the cost of revenue. So it is 64,000 is your opening inventory. Closing inventory, about the closing inventory it is mentioned that it is 4 times more than 4 times, okay, it has made 4 times of opening inventory. Opening inventory is 64, so 4 into 64, so it is 2,56,000. 2,56,000 is your closing inventory. Okay, so here cost of revenue from operation, it is 6,40,000 given in the question, and average inventory you have to find out. Opening is 64 and closing is 2,56,000 is the closing inventory upon 2. So 6,40,000 upon, we'll find out the average inventory. So 2,56,000 plus 64,000 plus 64,000. So 3,20,000 upon 2. So it's a 1,60,000 is the average inventory. 1,60,000. Is it clear? 1,60,000 is your average inventory. So it's 4 times. So average inventory turnover ratio is 4 times. Now coming to the next question. Next question is rupees 2 lakh is the cost of revenue from operations. Cost of revenue from operation is given. Cost of revenue from operation is given. Okay. 2 lakhs is the cost of revenue from operation. Inventory turnover is 8 times. Inventory turnover is given 8 times. Cost of revenue from operation is also given in this question. It is 2 lakhs. Okay. Inventory at the beginning is 1.5 times more than inventory at the end. Inventory at the beginning, suppose opening inventory and closing inventory. The information regarding two inventories is given in a different way. So opening inventory and closing inventory. So inventory at the beginning is 1.5 times more than the inventory at the end. Suppose inventory at the end is 1, it means inventory at the opening is 2.5, because it's more than 1.5. It is more than, inventory at the beginning is 1.5 more. So 1 plus 1.5, 1 plus 1.5, so it is 2.5. Inventory at the opening is 2.5, inventory at the closing is 1. Calculate the value of opening inventory and closing inventory. So here you calculate the average inventory is equal to, you write the average inventory, then average inventory is equal to 2 lakhs upon 8. So it is 25,000 is the average inventory. 25,000 is the average inventory. Now you see the ratio 1 and 2.5. So the average inventory is how much? Average inventory is opening inventory, average inventory is equal to opening inventory plus closing inventory upon 2. So average inventory is 25,000, we have already find it out, is equal to opening inventory plus closing inventory upon 2. So when cross multiplied it, so 50,000 is equal to opening inventory plus closing inventory opening inventory plus closing inventory is 50,000. This is 50,000. Okay. So see the relation in between these two. It is 2.5 and it is 1. Okay, 2.5 and it is 1. So total is how much? Total inventory is 3.5. Total, if you see the total, it is 3.5. So opening inventory is equal to opening inventory is equal to 2.5 upon 3.5 into 50,000, and closing inventory is equal to 1 upon 3.5 into 50,000. Okay, so 2.5 upon 3.5 into 50,000, it is 35,714, and this is 14,286. 14,286. So opening inventory 2.5 upon 3.5 into 50,000 and closing inventory 1 upon 3.5 into 50,000, that is 14,286. Okay. Now we'll see the next question of the same topic, inventory turnover ratio. So question is, following information is given to you. You calculate cost of revenue from operation, opening inventory, closing inventory, quick assets and current assets. So informations are inventory turnover ratio 5 times. Inventory at the end is 5,000 more than at the beginning. Revenue from operation all credit 2 lakhs. Gross profit ratio 1/4 on cost. It is given on cost. Current liability 60,000 and quick ratio 0.75. 0.75. So coming to the inventory turnover ratio, it is 5 times, it had given 5 times inventory turnover ratio, and cost of revenue from operation is not given, but revenue from operation is given in the question, and related to that one clue is given, the gross profit ratio 1/4 on cost. Suppose the cost is 100, then GP is 1/4 of it. So GP is 25, 1/4 of cost. So cost plus GP is your sales. So when sales is 125, your cost is 100. So cost of revenue is equal to 100 upon 125, and in the question revenue from operation is given, that is revenue from operation is all credit, it is 2 lakhs. So 1,60,000 is the cost of revenue. 1,60,000 is the cost of revenue. Coming to the average inventory, opening inventory plus closing inventory upon 2. So average inventory, first of all we will find out the average inventory. So average inventory is equal to 1,60,000 upon 5. So it is 32,000 is the average inventory. And you know the formula of average inventory. Average inventory means opening inventory plus closing inventory upon 2. So if the information is given in this question like this, inventory at the end is 5,000 more than inventory in the beginning. Suppose inventory at the beginning is X, it means closing inventory is X plus 5,000 upon 2, and average inventory is 32,000. So it is 64,000 is equal to 2x plus 5,000. Okay, so 5064 minus 5 is equal to 2x. So x is equal to 59,000 upon 2. So it is upon 2. So 29,500 is the opening inventory. 29,500 is opening inventory. X is what? It's the opening inventory. So closing inventory is how much? Closing inventory is 5,000 more than opening inventory. So 29,500 plus 5,000. So it is 34,500 is the closing inventory. Okay. So we have find out the opening inventory and closing inventory. Cost of revenue we have calculated 1,60,000 is the cost of revenue. Opening inventory is this, closing inventory is this. Now we have to calculate the quick assets and current assets. There is one formula is given about the quick ratio. Quick ratio is given, quick ratio. Okay, quick ratio. So I am going to write the formula of quick ratio, that is liquid ratio. Quick ratio is equal to, you know that quick ratio is equal to liquid assets upon current liability. So quick ratio is 0.75 is equal to liquid assets upon current liability. Current liability is given in the question, that is 60,000 current liability. So liquid assets is equal to 60,000 into 0.75. 60,000 into 0.75. So it is 45,000 is the liquid assets is 45,000. So one we have calculated liquid assets, and current assets is equal to liquid assets plus inventory, closing inventory. Liquid assets plus closing inventory. Liquid assets is 45,000 and closing inventory is, we have calculated 34,500 is the closing inventory. Okay, closing inventory is 34,500. So it is 79,500 is our current assets. Current assets is 79,500.